Comprehensive World Business and Financial News Recap, week of March 29th, 2025. This week, global financial and business developments have been characterized by strong stock market movements, significant corporate earnings, and an evolving landscape of central bank policies. Geopolitical risks, including ongoing conflicts and trade tensions, continue to influence markets, while sectors such as technology, renewable energy, and healthcare show promise for future growth. Here is an in-depth analysis of key events and their implications for investors. 1. Stock market movements. U.S. markets soar. Major stock indices like the S&P 500 and NASDAQ reached new highs, driven by exceptional earnings reports from tech giants, particularly in the AI and electric vehicle (EV) sectors. Companies such as NVIDIA and Tesla posted robust earnings, highlighting strong demand for AI-powered technologies and EVs. These growth areas remain the cornerstone of the U.S. equity market's resilience. Impact on investors. The tech sector continues to drive market growth, suggesting that companies focused on innovation, particularly in AI, cloud computing, and EVs, remain favorable investments. Investors should maintain exposure to these high-growth areas, especially those with established dominance in their respective fields. European markets under pressure. Meanwhile, European markets faced more significant pressure, primarily due to inflation concerns and geopolitical tensions. Inflation, though easing slightly, remains elevated in several countries, prompting central banks to stick to tightening monetary policies. Geopolitical risks, including the ongoing Russia-Ukraine conflict and uncertainty around energy prices, have added further volatility to European markets. Impact on investors. Investors in Europe face heightened risks, with geopolitical uncertainty and inflationary pressures weighing on market sentiment. It may be prudent to reduce exposure to European equities, particularly those in sectors that are heavily reliant on energy costs, and focus on more defensive investments like utilities or consumer staples. 2. Central bank policies. Federal Reserve's cautious stance. In the U.S., the Federal Reserve has indicated a cautious approach to potential interest rate cuts. While inflation is gradually easing, the Fed's primary concern remains economic stability. The central bank remains vigilant on inflation, making it likely that any rate cuts will be gradual and data-dependent. Impact on investors. Investors should remain prepared for volatility in interest-sensitive sectors. Long-duration assets like growth stocks may be impacted by delayed rate cuts. However, tech stocks could continue to benefit as lower rates stimulate demand for innovation-driven sectors. European Central Bank maintains tightening stance. The European Central Bank, ECB, has maintained its position on monetary tightening to combat persistent inflation. Despite easing inflation trends in some parts of Europe, the ECB has indicated that it will continue to focus on inflation control, which has led to market uncertainty, particularly in southern European economies. Impact on investors. The ECB's stance on tightening may continue to pressure the Eurozone economy. Investors should be cautious with European bonds and equities, particularly those sensitive to higher borrowing costs. Defensive sectors such as utilities or healthcare may provide more stability in the region. 3. Corporate earnings. Tech sector leads. Tech giants like NVIDIA and Tesla reported impressive earnings this week, underscoring the strength of the AI and EV sectors. NVIDIA's leadership in AI chips continues to be a cornerstone of growth in artificial intelligence, while Tesla's dominance in the electric vehicle market remains robust. Impact on investors. Companies in the AI, EV, and semiconductor spaces continue to show strong growth potential. NVIDIA, Tesla, and similar firms remain prime investment candidates for those seeking long-term growth. However, it is crucial to balance portfolios with sectors that may experience higher volatility, especially in times of regulatory uncertainty. Oil and gas, mixed earnings. Traditional industries like oil and gas reported mixed earnings, reflecting the volatility of energy prices. The conflict in Ukraine and OPEC Plus production cuts have kept oil prices relatively high, but the fluctuating nature of energy markets continues to create uncertainty for the sector. Impact on investors. While oil prices may remain elevated in the short term due to geopolitical factors, long-term growth in the energy sector remains uncertain due to the global transition toward renewable energy. Investors may want to limit exposure to energy stocks unless they are involved in clean energy technologies such as green hydrogen or solar energy. Number 4. Global trade. U.S.-China trade tensions resurface. Trade tensions between the U.S. and China resurfaced this week, with both nations imposing new tariffs on each other's goods. These trade conflicts could affect the supply chain, manufacturing industries, and investor sentiment globally. Impact on investors. Investors should be cautious of the volatility that may emerge from further deterioration in U.S.-China trade relations. Companies with significant exposure to China, particularly in the tech and manufacturing sectors, could face supply chain disruptions. Diversifying portfolios away from companies heavily reliant on trade with China may be beneficial. UK's new trade deals. In more positive news, the UK announced several new trade deals with India and Gulf nations, aiming to strengthen economic ties. These agreements focus on areas like technology, finance, and energy, positioning the UK as a strong player in the global trade landscape post-Brexit. Impact on investors. The UK's expanding trade ties with India and the Gulf could provide investors with new opportunities in emerging markets and sectors like tech and finance. Companies benefiting from these new trade agreements could be solid investment opportunities. Number 5. Cryptocurrency market volatility. Bitcoin and Ethereum experience volatility. The cryptocurrency market remains volatile, with Bitcoin and Ethereum experiencing price fluctuations amid ongoing regulatory uncertainties. Governments worldwide continue to assess how to regulate cryptocurrencies, particularly focusing on their use in financial systems. Impact on investors. Cryptocurrencies like Bitcoin and Ethereum continue to offer high-risk, high-reward opportunities for investors. However, the ongoing regulatory scrutiny may limit the growth potential of the sector in the short term. Investors seeking exposure to digital assets should consider a diversified approach and only invest a small portion of their portfolio in this high-risk asset class. Analysis. Pros and cons. Pros. Technological growth. The technology sector, particularly AI and EVs, continues to drive market innovation, offering lucrative opportunities for investors. The growth of AI and EVs presents long-term investment opportunities. Economic resilience. Despite various challenges, major economies have demonstrated resilience. Strong corporate earnings, particularly in the tech sector, and robust consumer spending are signs of economic health. Diversification opportunities. Emerging markets, alternative investments like cryptocurrencies, and sectors such as renewable energy provide avenues for portfolio diversification, which can reduce risk and increase returns. Cons. Geopolitical risks. Geopolitical tensions, such as the Israel-Hamas conflict, the Russia-Ukraine war, and U.S.-China trade tensions, pose significant risks to global stability. These risks could disrupt supply chains, influence commodity prices, and introduce volatility into global markets. Market volatility. Uncertainty in central bank policies, inflation rates, and geopolitical issues are contributing to fluctuating markets. This volatility could create opportunities but also poses risks for short-term investors. Regulatory challenges. Increased regulatory scrutiny on sectors like cryptocurrency and technology could impact the growth prospects of these industries, leading to potential market corrections. Investment advice. Mitigating portfolio risks. 1. Diversification across sectors and regions. To mitigate risks, investors should continue diversifying their portfolios across sectors and regions. Spreading investments across high-growth sectors like tech, renewable energy, and healthcare, as well as defensive assets such as bonds, can reduce exposure to geopolitical risks and market fluctuations. 2. Monitor central bank policies. Central bank decisions regarding interest rates will continue to shape market dynamics. Investors should closely monitor Federal Reserve and ECB policies, especially regarding rate cuts, as these could impact growth stocks and interest-sensitive sectors. 3. Risk management. In uncertain times, using stop-loss orders and maintaining a balanced portfolio with a mix of high-risk and low-risk assets is essential. Defensive sectors such as utilities and consumer staples can provide stability, while growth sectors like AI and renewable energy offer higher long-term returns. Potential investment opportunities. 1. Technology. Investing in companies leading in AI, cloud computing, and cybersecurity is likely to provide significant returns. These sectors are expected to benefit from continued technological advancements and increased adoption of digital solutions. 2. Renewable energy. Investments in solar, wind, and green technologies remain strong long-term opportunities, driven by the global push towards sustainability. As governments increase funding for clean energy, companies in this sector stand to benefit. 3. Healthcare. Healthcare remains robust, particularly in biotech, as advancements in medical technology continue to drive the industry forward. Investors should consider biotech firms with promising pipelines and established healthcare services. 4. Emerging markets. India and Southeast Asia present attractive opportunities due to their fast-growing economies and rising middle classes. Companies exposed to these regions may experience substantial growth as these markets continue to develop. 5. Real estate. Real estate investment trusts, REITs, in stable markets offer investors a reliable source of income. In regions where real estate demand remains strong, particularly in urbanized areas, REITs can provide steady returns. Number 6. Cryptocurrency. While volatile, cryptocurrencies like Bitcoin and Ethereum continue to offer high-risk, high-reward opportunities. Regulatory clarity in the future could present opportunities for greater growth. Predictions. Economic outlook. Inflation is expected to continue easing, with central banks likely to implement rate cuts by mid-2025. These actions will likely stimulate both consumer and business activity, leading to economic expansion. Geopolitical tensions may persist in the short term, but diplomatic efforts could help stabilize markets, particularly in regions like Eastern Europe and the Middle East. Technological growth. AI, cloud computing, and renewable energy will remain the leading drivers of technological innovation and investment. Investors should continue to focus on companies at the forefront of these industries for long-term growth. Social and environmental impact. Climate change initiatives and social reforms will shape global policies. Investors should consider focusing on ESG investments, as companies that prioritize sustainability and social equity are likely to benefit from regulatory incentives and consumer preference. Conclusion. This week's business and financial news highlights both opportunities and challenges for investors. While geopolitical risks and regulatory challenges create uncertainties, the continued growth of technology, renewable energy, and emerging markets offer significant potential. By maintaining a diversified portfolio and staying informed on central bank policies and global developments, investors can navigate these volatile times and capitalize on long-term growth opportunities.